Hello everyone, and welcome back to the channel. This is for Value Finder, and today we're taking a look at Microsoft Corporation, ticker MSFT. They had earnings this week, absolutely crushed it, but the stock did fall a bit the following day. I want to take a look and see with those earnings, that brings them to the full financial year of 2025 based on their calendar. So I have a full year's worth of data to take a look at compared to the other years. And I want to see where their valuation is at because I listened in on this earning call and it was amazing. This company is growing like crazy. So I'm coming up with a fair value of $423. It's currently trading for $524. Discounted cash flows, a little low. I know they're investing heavy in AI right now, in servers, the cloud, everything. So their cash flows are down. You can see there was a bit of a dip from 2024 to 2025. It's really nothing crazy. Without all this, you would have seen an uptrend, but they are investing. So that is part of why that's discounted. And then the retained income model of $304. We can take a quick look at the calculations there and see what's going on. Nothing crazy. I mean, if anything, the stock-based compensation is bringing that down a little bit, but they're still essentially flat on shares. So that's not like a red flag. It's just dragging them down a little bit. Now we get into the fundamentals, and I'll say everything here is incredible. Cash flows, usually 29%, came in at 25.4, still solid, down a little bit. We talked about why that is. Dividend is pretty low. They have on average been at 0.85 in the past few years, and right now they're at 0.65, and that's because the valuation is so high. I mean, at some point in the last 52 weeks, you could have gotten into this at $344.79. Right now, it's a whole lot more than that. It went as high as $555 during the run-up during the earnings call. ROE, 29.74. I think that's one of the highest that we've seen, with a debt to equity of 0.8. So this isn't really skewed. Balance sheet's in good shape. They just have really good returns. Return on investment, 17.56. Solid. And return on assets, 16.5. I mean, you can't really ask for anything better than those returns. Gross margins, 68.79. On average, they're right around 69 typically. Net margins, 36.17. And on average, 35.75. So even with increased spend, their net margin is up. And that's because this spend is leading to higher margin business segment growth. So you'll see down in the thesis, I've got a pretty big margin growth because they're seeing margin growth. I know that they just rose the cost on Power BI recently by, I think, nearly 50%. It used to be about $10 a user, and now it's $14 to $15. And I mean, we're a company with 100 employees where all of a sudden they're making, we're talking monthly as well. So now they're making $500 a month extra off of us, which means they're making an extra $6,000 a year. And we can't just move away from the system. They've got you locked in. It's a good product. So, I mean, I can understand why they're in such a solid position. PE currently is almost 34. You know, I'd like to see that closer to a 30. Actually, 34 is probably not too bad. If they're getting annual growth of about 18%, we're talking about 15 for the general market for a PE, and we'd be looking at a growth rate of about 8%. So I'd say 30 for a 16% growth would be fine, which means 34 for 18% growth. It's okay. It's not insane. The earnings are actually growing at 16.7%, so that's a PEG of 2. So really, earnings-wise, it's twice what we'd like to see for that PEG. I mean, the earnings yield's really low too on an earnings front. It's overvalued, but there's a reason for that. It trades at a high multiple. A lot of these stocks we look at, I keep saying it's trading at 3-year out values. This one's not yet. It's at 583 in 3 years for the fair value, and right now it's only at 524. Because when I was looking at what some analysts were saying about the stock, their price target was like 590, and I thought that they were insane. And then I dug a bit deeper into the growth in the business, and then I looked at this. You know, I guess if I were doing a number like theirs, my price target would be 580, 585, somewhere in there. So they're not too far off. Now, personally, for my personal portfolio, I would really like to get into this stock under $500 because, like I said, I'm coming up with a fair value of 423. It's being dragged down by the discounted cash flow and the retained income model, definitely. But even with that fair value and 1 year at the growth rate, you're already looking at $500. So I think $500 within the next year would definitely be my entry position. So we can go through this thesis a little bit. Analysts are projecting growth in the next year of revenues of 13.9, over the next 2 years, 14.25. So right around that 14% range. Share count, I mean, I'd like to see them buy it back. They have in the last 3, kind of stopped in the last 2. They're probably dedicating that spend towards cloud and AI. If they can implement it to any degree, it's beneficial for shareholders. I mean, 0.1% is nothing crazy, but that 0.1% adds up across every metric because there's less shares. Cash flow growth, I'm putting 17% because at some point in the next 5 years, ideally, they're either leveling out or cutting off some of the excess spend. And the 17% growth would take them only to 29 on their cash flow yield, which is just south of what they've been on average over the last few years. Asset growth of 20%, I mean, it's right in the range, 19.25, 22.57. Liabilities, same story here, 1171, 15.75. Dividend growth, they keep doing it at 10%. They have so much room to grow it, so much room. Based off the projected earnings for this year, they're at a payout ratio of 20%. I mean, there's a good 10% more that they can pay out and be on the lower end of what we like for a dividend. So earnings projections for this fiscal year, they're in 2026 based on their calendar, 15.46. So an extra 10%, we're looking at them paying out another $1.55 over the course of the year. They've been growing it decently. And then margins, as I said, this investment is into higher margin segments. So we're likely to see that go up. I mean, this 3% takes them to almost 42% margins over the next 5 years, which is high, but they've got the pricing power. If they wanted to do it, they can. I can cut this down a little bit. You'll see they lost about 0.5% on the growth rate here, cutting it down 1%, but that only takes them to 40% on their gross margins. And if we do 1, you'll see they dropped again. Now it's only 16.8 here. It takes them to 38%. So, I mean, we have to see how everything plays out with these higher margin segments, but we know that that's going to be a metric that's growing more than the minimal amount. And that covers the thesis. I mean, it depends on what kind of investor you are. If you're a growth investor, I don't think that it's bad. I think 550 would be fine. 550 to 590, probably, based on what we've seen analyzing stocks. Go check out some of the other videos on these FANG stocks, massive growth stocks. They're all trading at like 3-year out valuation. If you're a value investor, margin of safety based off the calculated fair value, it's about $300. But once you look at everything holistically, you know that it's a bit better than that. They're seeing some massive growth in their earnings too. So those investors who are just trading based off the PE, it might be a little overvalued right now, but they'll probably be getting in around that $500 level as well. Once that PE gets back down to around 30, which is what I would personally want to target on this stock. We can go take a quick look at the prices. I know in the past I've been a little skeptical of this company and thought that it was overvalued. Sitting through the earnings call helps out a lot. Reading through the plans and some of the growth that they've been doing lately helps. Let's look at it like this. Back in 2023, it had a share price of $269 and a fair value right around that same level of about $260. Then in 2024, it had a share price of $314 with a fair value of $307. This last year, there was a bit of a divergence. Fair value of $350, share price of $420. Looking at the valuations, balance sheet lags behind everything. It's hard with such a big balance sheet to really make massive gains there, but it is on a nice trend, and that's all that we can ask for. Cash flows, honestly, looking at this, are pretty flat. Definitely trending up over time, but as we said, they're investing more. It's coming out of those cash flows, so that shouldn't be too much of a surprise. Fair value is just a nice straight line. Look at that. Just linear growth, projected to surpass the dividend value in 2027. Dividend, nice linear growth there. They're growing it consistently 10%, and they can continue that for quite some time. Earnings definitely took a jump in 2024. I mean, everything is just a straight diagonal line upwards. Even the share price right here, back in 2024, about $314 and $420. And we have the value in 2026 because they're in fiscal year 2026 to get it on the same line as everything else for that year, because these are all based off the projections. 524 right now. We'll see how the average pans out over the course of this fiscal year. But looking at this, it seems a little overvalued when you put it this way, where you can see historically you've been able to get it for close to the fair value, if not the earnings value, and it's kind of far and above everything. But these are back-looking numbers. So, maybe they just overperformed and the market saw that coming and adjusted accordingly and set the price at a good level through 2024. So that's all that I have to say for this one. It's on my watch list. I do plan to buy if it dips below $500. If it continues below that, I'm definitely dollar cost averaging, because when it comes to some of the bigger stocks in the S&P, I can definitely see the future with this one because I use their products all the time. Their email service. I have it personal and for work. For work, I'm literally paid to use their software for Excel, for Power BI, for PowerPoint. It's probably the company with some of the biggest impact on my life. And you got to pay for it. Their services don't come for free. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.